So look, nothing's happened on SPY today. I mean, we go to SPX. I guess let's look at the options flow. Let's see. We can talk about all this with Chris and Jeff. But let's look at the options flow. I saw, what did I just see coming in? Sometimes when I'm scrolling, it updates and I have to start over. Scrolling. Let's see. Oh yeah, Elf. A lot of puts on Elf. $120 puts. So kind of like the interesting thing about these options flows is you have to figure out, do you want to play the reversal because you can get in cheaper, or do you want to play the um trend with these things? So for instance, we see these puts coming in on Elf. Let me go ahead and move this over. We see these puts coming in on Elf at 120 put for this week. But yeah, it's this week. So we can go over here to see Doug,
I'm checking now for you.
okay, yeah, thank you, man. Blake's on that. Yeah, we got we've been running that track record for a couple of years now. So, yeah, so we optimize everything here at WealthPin, including our track record, tracking, the way we track it, make it a little easier for people to see. We have to update the way that we track that. So we have a lot of 120 puts coming in on Elf. We also have a 105. Did I see that? For August 29th. That's way out of the money though. So that's probably gonna be cheap. It's probably gonna be a little. Let me go ahead. I need another monitor, dude. I have two monitors, and I have a monitor and a laptop. I need another
Man,
monitor.
let me tell you, 3 is life changing.
I know, dude.
4 is ridiculous, but 3 is great.
Yeah, four might be too scary for me.
Yeah, I have 4. Well, I had 4. I need to hook the fourth
Oh
one
wow.
back up, but it's
Wow.
nice. I'm not gonna lie, it's nice.
What do you? Yeah, do you have a desktop? I need. See, my laptop won't actually cast to any more than one. And my
Mhm.
Mac is kind of stupid. I think I'm gonna get a Windows.
Yes, because like my GPU has 4 slots,
Yeah,
so
yeah, that's awesome.
yeah, I'm lucky. I won't lie.
To get that. Uh,
But yeah, to answer that question about the trade tracker, I'm gonna have to put together. Just give me a minute on this one.
Okay, yeah, thank you, sir. It's also, we do the buy and holds as well, like, so it's both options and the underlying. All right, let's see. Let's go over here. So these ELF 120 calls, 120 puts, I mean, August 22nd. Not too much volume. It's kind of an expensive one, 251 too. For 251 for that. Now your volume is 492 over the open interest of 46. Not super solid. If we go over this 29th call for ELF, where is it? That was the 105. Bro, that's 600. That's interesting. 600 to, let's see if there's a corresponding one on the call side. There's not. So that's only for 102, 105. That's only 44 bucks. That is so far out of the money though. I mean, so these will like, if it does drop, they will, even the out of the money ones will increase too. It's right at the 200 moving average. Not really liking that though. Let's keep on scrolling. Come on, bro. I always see MD Mongo is always on here, but it's super expensive. So I never send it out. There's always, and it's just, I don't know. Pins. Pins is Pinterest, right? Let's look it up.
Yes, that is correct.
Okay, so we have a little bit of a crossover on the 50. So this is the 200 blue, 50 is the purple, and we have the 9 and the 20, yellow and green, or green and yellow rather. Green is the 9, 20 is the yellow. There's only one call. There's only one call over here on pins for 37.50 this week. At 7,231 over 270. We've had earnings going for a call, 37.50. We are breaking out. All right. It's only 3% out of the money. So the problem when sometimes you have to, so if you remember that ELF one, the 105 for next week, that was about what, 13% out of the money. So those are going to be like, I like to find a sweet spot about 3 to 5% out of the money, which is a little bit, obviously it's higher probability. Doug, I do think insider intelligence is worth keeping. I mean, we just had a 436 game last week on Tilray. It's a weed stock. Before that, we had another. I think we had like an 80% winner. So, and then before that, a 50%. We've been kind of hot on insider intelligence, so at least give it a little while, Doug. I saw you join this weekend, and welcome to that. Okay, so pins is so we only have one. I usually look for two or three. What's up, Jeff?
What's happening?
Just going through my unusual options scanner, trying to figure out if so pins is going to be on the watch list, ladies and gentlemen. I'm going to watch it. I want to see to go to the 5 minutes. We'll see. We'll see about pins. Do have a pretty strong uptrend. A little bit. We're still below the 9 and the 20. Let me go ahead and add percent change to see how much I like to add percent change on the options chain just to see how much it's changed. Today. 3750 is up 3.8%. Oh no, 3750 is up 6% today. So we could, and this is only 16 bucks. 16 cents per contract. And we need Pinterest to move higher. Just a little bit, maybe get like a 10% pop. I'm gonna wait for one other flow to come in on this pins. I'm gonna wait to see if one other flow comes in, then we might take this one. I like it's cheap, it's in the money, or not in the money, it's close to the money, only 3.5% out. So what's up, Chris?
What up? Happy Monday.
Happy Monday.
How's everybody doing?
Good, man. How's how you?
Good, man.
Take the bike?
Yeah, I actually did a nice ride on Saturday. Went down to Park City and picked up a little ring action on Saturday, but I had a nice 2 hour cruise on the bike. So it was pretty awesome, man. It was funny, like so we're up in Farmington, like 20 minutes north of Salt Lake City, and I mean we're at like 5,000 feet elevation, 5,500 feet elevation, and it's still like 90 plus degrees here, like all summer long. But drove into Park City, which is sitting around like 65 to 7,000 feet elevation, and it's like 15 degrees cooler, 20 degrees
Yeah.
cooler. So that was like my favorite part. I also got a sweet little sunburn on my wrist from having the little gap between my gloves and shirt.
Oh, nice, man.
Yep.
Now you didn't run out of gas, right?
I didn't know. So this is a new bike, by the way. So I've already swapped. I don't know when I talked about this last week. Did I tell you I was swapping bikes?
Yeah.
I've already
Yeah.
sold. I sold the first bike that I had that ran out of gas.
Oh, okay.
But I have a bigger bike, so now I have a Triumph Thunderbird, which was a pretty sweet bike I knew of back in the day, and that's a 1700 cc's. It's got plenty of get up and go. It can cruise at 80, 85. In fact, I think I used maybe a quarter tank going almost 120 miles, which isn't too bad. So it's a good trade-off. I think I traded up the right way.
That's awesome, man.
Back in the 80s, I used to drive a Triumph Spitfire 1500.
There you go. That's the little orange. I mean, my grandparents had like a little orange Spitfire.
Yeah, mine was
Yeah.
white.
That's awesome, man. Was it a stick shift?
Yep.
Yeah, that's what I'm talking about.
Had a rag top on it. It was awesome.
Very cool.
Stick shift. What is it in biking terms that because you normally change the gears with the rotating the handle, right?
Yeah, a bike you just have it's your foot. You have a foot clutch, so you go like
Okay.
1 down for first gear and then 5 up for gears 2 through 6.
Mhm.
Yep. So you just clutch on the left and then you're just using your foot. Some bigger bikes have like a heel clutch as well as a toe clutch. If you ever rode like a dirt bike or four-wheeler, it's kind of the same mechanism. Some bikes now, like the Can-Ams and the Spiders and some of the fancy ones that are like trikes and the four-wheeler type motorcycles have like they're automatic. So I think that's the enjoyment for me is like I like the shifting. That's the fun part.
Yeah, that's awesome, man. I bet it's beautiful, beautiful driving out there.
It really is, man. I mean, it's hard not to live where we live and think like if there's a cool way to see like the mountains and stuff outside of hiking, which my fiance hikes a ton. We hiked a lot together like the last couple of years, but some of the spots are just awesome. Like you've got the biggest payouts. Like you go, 9, 10, 11,000 feet in the air, check out a summit. It's beautiful. Like you see some breathtaking views. It's
Yeah,
fun.
man, Utah, I love Utah. We've been out to Zion,
Yep.
Bryce. It's great. It's great country.
Yep.
We can come back. We'll do do those private rooms for this. We'll do more rooms with this. Maybe I'll start tuning in at 10:30 each morning, folks, to do these more scans on these beginning of the day option flows. I see a lot of U, but also I see a lot of calls and puts. It's kind of a mixed on U, so I'm not quite sure. It's not really strong either direction. I don't know what U is doing here real quick. Yeah, okay, it's going up. I mean, it's pretty solid. It might not be a bad idea just to go to long this. So you and Pinterest are on it. I'm sure we'll be talking. Chris will be talking. Jeff will be talking. I'll keep on looking at this, see what we do for you. Might be able to get a quick winner today or overnight tomorrow on you. I'll see though. I'll think about Pinterest or you for this. So those are the two on the watch list so far. And then if any more come in later, we'll send them out in the Telegram, folks, and be on the lookout. But yeah, look at this today. What is this? This is the flattest. This is the flattest opening range we've had in a long time.
Yeah, it's pretty perfect though. I went 3 for 3 this morning with daily profit play. I thought, okay, so what do we have pressing this week? We have Jackson Hole on Thursday, Friday, kind of kicking things off, which is always kind of a wild card. Like I don't know if Jackson Hole. I mean, I think Jackson Hole this year with Powell speaking on Friday, maybe they get some markets rattled a little bit. Last year, if I'm not mistaken, last year was Jackson Hole and NVIDIA earnings in the same week. This year they're different. Like NVIDIA's next week, but we still have FOMC minutes on Wednesday. We have Jackson Hole Thursday, Friday. So it's kind of all eyes on the Fed this week, in my opinion. And if you take a look at the CME watch tool for the Fed, there's a pretty big adjustment that the Fed is still looking to cut September 17th at like 83% probability, but that's a huge shift from what was 94% last week. Like it was like 94% the Fed's going to cut, like pretty much guaranteed, baked in. Now it's like 83% with a potential pause at like 17%. So I have no idea why the markets are like changing so abruptly, but it's still, keep in mind, probability wise, Fed's going to cut in September. I think it's just, and I've been like on the defense for Powell, thinking like if they let the inflation genie out of the box, which we did back in like 2021, 2022, now they spent 3 years trying to put it back in the box. So like genie's trying to go back in the lamp for inflation. I just wonder if like Powell's legacy is under this guy's tenure, he didn't let inflation get bad. But at the same time, I think that right now that if the Fed doesn't cut and doesn't become somewhat accommodative, that the US is no longer going to hit that growth trajectory that they want to see over these next like 2 years. I think it's important that for Trump to stay, in the majority and in power, he can't have a disruptive midterm. Like so much has come out so fast with Trump in, passing tariffs and passing the big beautiful ugly tax bill, just a tax extension really. But it's like pro growth, pro deregulation. All these things are good, But if the monetary policy is slowing down based on lagging inflation data, um, I just I don't know how any of this is going to be good. It's weird to cut at all-time highs, I will say that, but I think that at this point, I mean, tech has pretty much led the way. You know, like tech is the reason the market's been resilient. AI is the biggest hype. The S&P is kind of underperforming. I mean, I'd like your input, guys. Am I wrong? Is it like market breadth is crazy bullish, or is it more like we're kind of getting concentrated again?
You
8% of
take
the
out the
S&P is
mags out of
freaking
the S.
NVIDIA.
Yeah, I'm gonna say you take the mags out of the S&P, and the S&P is pretty much flat.
Exactly.
I would
And
like
that's
to chime in here if I can.
Go
I don't
ahead.
know if you guys have noticed, but all of last week, the market would go up and then it would go down. Then it would go up and then it would go down. And just felt like last week they started to really kind of, I don't know, it's like that shift. Maybe I'm wrong, but it just, something doesn't feel right?
Yeah, we had 2 days of indecision last week. I mean, between Wednesday and Thursday, it would have been, yeah, Wednesday, Thursday last week were pretty much the same day. We did have a melt up on Tuesday. So, I mean, again, if you're looking at the numbers behind the scenes, there's a giant call wall from the JP Morgan investment side at 6,500. So, and that's a quarterly expiration. So we could certainly poke above 65, but between like 6,500, 6,550, there's a lot of positive gamma, which is going to force basically when markets go higher, people are selling calls. When markets go lower, people are buying. So it's like what narrows volatility is positive gamma. So 6,500 is a pretty big call wall.
That means
there's-
we're probably gonna drift towards 6,500.
Yeah, so we hit two highs last week at 64.80. So I mean, drifting to it or staying right here around this, like maybe this week, I'm just throwing it out there. If Jackson Hole's not super disruptive, I could see the market just kind of being noise. 6,400, 6,500, just kind of staying in that like 50 to 100 point range. I don't see a lot of direction this week. I mean, I see NVIDIA next week as we wrap up the month. I mean, next week's calendar is going to be what? So I wonder if we have NVIDIA earnings on the 27th, and then do we have core PCE on Friday? Is that next week?
Next week we
Yeah.
yep.
So to finish out the month, like the trading month, we're going to have uh, Wednesday earnings on the 27th, and then core PCE on Friday at 8:30. Yeah, to wrap up the month. So again, NVIDIA at like 8% of the entire S&P. It's like I think one of the largest ever to have a stock that's concentrated. It's that concentrated at $4+ trillion. I think like again, it's silly to say this, but it's like the whole market's kind of riding on like a good, stable NVIDIA print.
That's what I've
Which
been saying, man. I've been saying
Yeah.
we're gonna drift higher until NVIDIA on the 27th. And then we're either gonna go higher or that's gonna start like the September sort of sell-off there.
Yeah.
I
And that combination of like, that timing of NVIDIA earnings and then the September rate decision, it's like, I don't, I'd be shocked to see September somehow keep pushing us higher. I could see, like you said this last week, Alex, I could see us pushing higher into, August, but slowly, like super, super slowly drifting higher. But if we have a hiccup and the market, pulls back to like the 50-day moving average, I mean, it's only like a 3 to 4% correction. It's not even that big of a deal, but it's like the fact that it has to line up like all these terrible things have to happen for the market to have any type of dip or pullback. You just don't want to see the market like break on something. I know we've had some Slack messages going around about concerns and recessions. I mean, we've noticed we were at like Topgolf last week, and this like restaurant of ours that was kind of our favorite spot was out of business. They've closed 4 locations in Salt Lake City in this last like year, which is kind of weird. Like it was, I mean, it was burgers, wings, and beer, and they closed 4 locations. And something tells me that's not like for lack of patronage. I feel like that's probably some bad accounting, maybe, or just equipment, labor, and food costs have gone up so much that they were like on thin margins. I'm not sure.
or
well, how
divorce.
how was the foot traffic there?
What's that?
I
It
said,
was, it
or
was awesome. Like I mean, they have 4 locations, and they like every time we went, they were always busy. They were always busy.
Yeah.
So anyway,
yeah, we had
um,
one here that did that, but it was because of divorce.
yeah,
And so they split it all up, and then one wanted to half, one wanted the other half, and So they just closed all the restaurants and called it good. And I was just like, ah.
Interesting.
I mean,
Yeah,
somebody
that-
should have kept it open.
Never good.
Don't get
So-
divorced, ladies and gentlemen.
Let's see here. I'm looking at a couple of trades. Let me see for my waterfall. All right, so I got August 20. This will be an interesting trade to dissect. I do this for one of my services, waterfall income. This is kind of a fancier trade that I did, but I do have a level 65.35 by August 29th, which is next Friday. I don't want to see SPX above 65.35. If it's below 65.35, that's great. I've got $160 of income. I also potentially have like a $5 wide profit trap, so I can make 660 bucks on that trade. I'd like the tail end of this month to kind of stall a little bit. What are we month to date in August right now? Let me look at the monthly.
For
Our,
SP,
our candle's probably green, but yeah, I mean this market from
definitely
April's recovery, May, June, July, August. It's just, I mean, the low of August to now, we've had a candle that's about 4.28%. Body of the candle open and up. The body's up around 2.53%. August is usually like a flat month. September is usually a down month. So if history is any guide, I mean, I could see August like, yeah, maybe we hang out to this like 2+% gain. Maybe we give some of it back, but still maintain like a sliver of positivity for August. I would just be shocked, guys. I mean, I, let's just talk simple technicals, right? Do you see overbought conditions and divergence right now in S&P and NASDAQ? Because I do. Do you see it?
yeah, but that's been the case for 10 years almost.
No. I'm just talking like near term. I'm talking like literally near term. I've got all my indicators that I usually am like very reliable highs and lows in the markets. We have one forming highs. So if you want me to show you the screen, I'm happy to show it.
Go ahead, go ahead. Yeah,
Okay,
yeah.
all
Let me
right.
stop
That'll,
sharing.
maybe I can drive it in there. So
Let's do it.
all right. So I'll show you what this breakdown is. This indicator is a print of relative strength as well as momentum. So it's a momentum oscillator. And what I'm looking for is if we go price goes higher, okay, but momentum is making lower highs, and then relative strength makes a high and a lower high. So we have price going up. Okay, so if price goes higher, but we have momentum disagreeing with that, and we have relative strength disagreeing with that. That is hidden bearish divergence. So this indicator encompasses that, and we have it's just printing more and more steadily on the S&P. It did it back here when we formed a top through that July-August correction. It formed it right here and we ran. And I understand, like, this indicator is not foolproof, but what I like is when this indicator starts to print slightly at a lesser angle, that tends to be like a more important kind of top out. So because we're just barely grinding, so we've had like these multiple prints here at the highs. If I show you the guts of this, let me go into this workspace, and this chart's a lot messier, so just bear with me. But if I go S&P, so let's go SPX. Okay, this should be pretty easy to see. Price has made slightly higher highs, right? So we're making higher highs, just barely grinding higher. So price makes higher highs. Momentum, lower highs. Okay, relative strength, we were overbought. Relative strength. This is a 21 period and a 14-day period. Overbought conditions. Money flow has been decreasing as well as momentum topping out. So it's, again, this is an anticipation. Like, this to me is kind of one of my better like leading indicators. But the hard part about this is I can have all these things line up, and it doesn't necessarily mean that I don't know when to time this. I would say that I'd be shocked to see the market not correct by the end of September. And when I say correct, I mean like down to like the 50-day. I mean, we're talking maybe a 3% correction, again, kind of like we had back in August briefly, right? That July 31st to August 1st, that 2-day window was a 3.33% correction on the S&P and a 3.5% correction on the NASDAQ. That's all I'm looking for, like, as a minimum. But obviously it can get a little bit worse and maybe retest all-time highs, and now we're talking like 4 to 5%. But that's about it. Like, just some type of little rattle and some type of little shakeout. The problem is I don't want to see the market dip, too much lower than these like supportive moving averages. To me, like, the whole structure of the bull market changes if we're below 5,700. If the S&P is below 57, I'm questioning the integrity and the stay power of this bull market. Because I don't know what's going to line up to make things worse, but I don't know. Maybe the Fed just completely I don't know. Maybe they completely disappoint the market. They don't want to cut it all, and that's just like a huge shock to the market, right? Because what have we had? We've had consumers and businesses waiting for the Fed to cut. They did cut last year, but the bond markets didn't react the right way, and now we go into this next like cutting cycle. It usually, I mean, I don't know. Cut cycles don't usually spell big bullish moves in the market, especially when we're trading all-time highs.
But how does that compare to the Russell?
Like what? Just overbought conditions?
Well, yeah, I mean the Russell 2000. I mean what I've been noticing here. I mean the Russell's been our weakest market
Yeah.
throughout the whole thing,
Yep.
and now all of a sudden it's starting to pop up, and it seems
Yep.
like it's gaining strength as opposed to the no Nasdaq and the S&P starting to kind of wig out a little bit and kind of. But it looks like it's doing the same thing, isn't it?
Yeah, they all kind of are. I mean, the
Yeah,
more noticeable ones to me, it's like the S&P and the Nasdaq by far at all-time highs, like definitely more noticeable overbought conditions with divergence. The Russell
right.
has it a little bit, but I will say this: the I'm kind of stuck between this. Like, do we have like the catch-up trade? I mean, the S&P at all-time highs, the Nasdaq at all-time highs. The market is highly anticipating rate cuts. Is it possible that there's two ways that market breadth works, right? Market breadth works where there's a catch-up trade where everything can go like let's say the Russell can outperform and still rally as the S&P might go a little bit slower and the Nasdaq a little bit slower, right? So
Right.
the Russell can catch up and outperform those. That's what it's done through August so far. And if we get back to all-time highs in the Russell, that is what Jeff's saying. That's a catch-up trade, and that's a great
Exactly.
sign for market breadth.
Well,
Yeah.
rate cuts should be good for Russell
Oh
because
yeah,
cheaper
that's
Yeah,
what
they,
I'm
they should,
saying.
in
cheaper
theory they should
financing
be.
for all the
That's
companies.
that's why I was wondering how that compared to the Russell because I think that it's going to help the Russell out a whole lot more. And I think that catch-up trade that you're just talking about might happen if they do cut with those rates.
Yeah, my again, rate cuts though, we're not cutting the long end of the curve.
Uh,
That's the weird pickle that we're in right now. It's like we could cut another 75 basis points. We can cut September, October, December. If this US 10-year yield does not get lower, nothing's changing. Like mortgages are barely going to budge, borrowing for an auto loan, borrowing for any type of debt restructuring or refinancing, nothing's going to change for the better if this 10-year yield doesn't drop,
Right.
you know? And that's like the
Hey,
one thing that's so weird is like right now risk premium is like being asked to go higher. It's like bond yields are up across the globe and our yields are no better. um I don't know, and this is like literally my biggest question mark of the rest of this year is, are we going to see this rate cut for 2025 and all of a sudden the markets do this? If the market yields on the 10-year go up, okay, that can't be a good thing for anything. Like that means that by the time we get up here, it's going to start choking out growth. Your whole window of like, I want to refi a house. Well, now it's more expensive. I want to refi. I want to get a car. It's more expensive. I want to refi my business. I've got $40 trillion globally of debt that needs to be refinanced. That's more expensive now. It's like that's the weird thing that we're trying to grow our way out of this. Um, I don't know how you do it if we're going to
well,
see
for
like a
people who
stalling Fed.
for people who don't know, like necessarily, and I'm not saying I'm a bond expert, but the Fed can. You saw this when they did cut. They cut 100 basis points. The 10-year rose 100 basis points.
Correct.
So it's something called bond vigilantism. It's the bond market doesn't necessarily agree with the Fed all the time. So if they're wanting in their cuts and the bond market says you shouldn't be, it doesn't really matter for yields. They'll just do what they want to do. So the Fed has power. It's not as powerful as maybe you think it is for interest rates. Um, I guess the bigger like the philosophical is like what makes interest rates come down. And I don't know. Outside of a recession and a really bad economic print or situation, I'm not sure what makes interest rates come down.
Well, this is what I just typed this in. So if we start to see, and this is what the weird part was last year, the Fed cut 100 basis points, like you said, Alex, and the market went up about 117 basis points. Now we haven't really gone anywhere. It's like we had the Fed started cutting here, and then the market just kind of stabilized after the fact. But it was like the extreme rate of change that disrupted the market, and the extreme rate of change that disrupted the market this year. When I put higher yields also change, this is change, not chance, change earnings expectations. Look, if the Fed is going to cut less, and believe me, we have a president that is so vocal that if the Fed does not cut in September, he is going to lose his mind. And if the Fed doesn't cut in October or December, he's going to lose his mind.
Yeah.
Now, I was for most of this year seeing that like inflation's been stickier and it's not really going down. I don't believe in the 2% inflation target. I think that's a completely subjective level that we've just said for the last, 70 years on some New Zealand-based indicator. That's kind of how this whole thing started with 2% inflation target. It's just arbitrary and it's subjective. I think that for the U.S. to benefit, the Fed has to really adjust inflation expectations to say we're okay with like a range. Like we have to operate between like maybe 2 to 3% inflation is acceptable because we can grow through that. We can have nominal GDP at like 3% growth, 4% growth, and inflation can be 2 to 3%. We can still pace and have like real growth of 1%. But if we're only growing at 1% with inflation targets at 2%, that we're sitting at 2.5%, 3%, it's like we have negative nominal growth, or should say real growth. So
Yeah.
I think we're at this like critical spot where the Fed is either going to push this economy into like a stall, and if higher yields change earnings expectations, I mean, the true drivers of the market is going to be earnings, earnings expectations, forward guidance, and interest rates. So if interest rates are coming down, okay, fine, but it's weird. It's just weird that they're coming down on like the short end of the curve because that's how we're refinancing debt. We're doing everything short end of the curve, which means it's like Yellonomics, if that's even a thing. We're basically raising debt at like the 2 years or less. And so everything that we want to like buy a house, that's 15 to 30-year mortgages. That's way out on the long end of the curve. Yields have not budged. They're still high, they're still sticky, and a lot of it's based on what this 10 year is doing. So,
I'll tell you what's interesting is I've seen DC historically one of the most insulated real estate markets in the world.
Yeah.
At least in America, probably the world though. I would say. But housing prices are dropping. It is very interesting to see because it's almost I've never seen that. Now they are still.
But how much higher are they from the last 3, 4, 5 years?
They're still a lot higher. They're still a lot
Okay.
higher, but
Okay.
but people are dropping prices. We're having some 15, 20K cuts. So,
Yeah. So this is, and a lot of people are kind of frozen, right? Because right now, if you wanted to move, you've got to sell high, and then you got to buy high,
yeah.
right? Because prices have gone up, so you're selling it. I mean, and I think right now, like if you're trying to sell a home, you're probably not going to get what you thought you could get. It totally depends on your market, but I mean, I know that case in point, like I go down a couple times a week into the Park City area, and homes that were bought, 5 or 6 years ago, that for maybe like $300,000 to $350,000, ththose homes are now being appraised at $1.2 million. They're not worth that much money, right? Like it's not $1 million home, okay? It's a 300 some $1,000 home.
Yeah.
But if people are trying to sell those homes now, they're listing them for like 1.1, better than being cut to 1.005. They're cut to $1 million. They're cut to 950. They're cut to. It's like there's plenty of equity to like say, all right, honey, we're not going to get our $1 million out of the home, but we can get 950. We can still get $600,000 on our house for the last 5 years. It's like that's silly amounts of equity and growth, right? So I mean, house prices coming down. It's really just how motivated are the sellers to sell? Because if you're motivated to sell, you're cutting your prices.
But another problem that you've got though is, yeah, you can sell your house at a higher price. You're gonna have to buy a house at the higher price. But
That's
go back
exactly.
5 years, I got
Yep.
my first house at 3.5%. Now I'm doing 7%.
That's
Now
exactly why I
you're
said
really
sell
getting
high,
hammered.
sell high, buy high, because
Yeah.
it's why people are frozen. It's like, and people think like we're gonna have this housing crisis. We won't. We won't have a
No.
housing crisis because we have like 70% of all mortgages are like sub 4%.
Yeah.
Everyone that refied during COVID, everyone that did like another 15-year, 30-year mortgage at like sub 4%, sub 3% for some,
Yep.
that like you shouldn't ever have to move. But obviously when people are changing jobs or relocating or wanting to move or upgrade, it's like just some people are stuck. But you're gonna, just like you said, Jeff, you're gonna sell high and try to get like, oh, that's great, we can get $600,000, but that's gonna go right into another house that's probably not really $1 million house.
Right.
So it's like you sell your $300,000 house for $1 million, and then you take that $700K, you're going to park that in for a 20% down payment, and then you're paying a way higher interest rate. Which the most depressing thing is looking out 30 years on a mortgage and seeing if I pay this mortgage every single month,
Interest-
how much
you
is
pay.
interest compared to
Yeah.
my principal?
I know.
Yeah.
How much is interest?
It's
You know,
crazy.
it's like 80% interest payment,
Yeah.
Yeah.
if not
You buy
more.
a
It's
700K
ridiculous, man.
house, you're
It's
paying
ridiculous.
1.2
Yeah.
million over the course of that loan,
Yep.
basically.
So I mean,
Um,
we're in a house like this is a new house. It's a brand new build. We've been in here for about 3 months, and I mean, I am proactively like if I can put an extra 50K down in this house, like principal, I'm gonna do it every single year. Like there's no reason for me to ever feel like I'm gonna be paying double or 2.5 times the cost of this house over the life of a mortgage at these rates. So
Yeah.
and I closed like so we had Liberation Day, which for a split second might have seen rates around like low sixes. And I closed right here at a 6.6. And right now it's like, I mean, I'm seeing some, I'm pretty sure they're false readings, but I'm thinking right now, I mean, this is my stat. I mean, I've got the 30-year average mortgage here. This shows 6.58 for the average 30-year. So that's what it's showing. And I'm not sure if that's like true or based on your credit score, like, but I will refi. I'll refi my house if it becomes like 5.5 or less. Just on that alone, it's like we can probably shave off another $250 to $500 a month on just
Yeah.
Oh,
that,
yeah.
and I'll still stay ahead on principal. So I'm watching. It's like it's one of the biggest investments that people make is buying a home and hopefully having some equity in it. But it's certainly not easy to make these decisions. And the arguments are, well, you know, when I bought a house, it was a 15% interest rate. Yeah, but your house was $50,000 to $80,000. You know, it was
Well, it
two
was
times
also
salary,
four
not 6
times
times
your
salary.
4 times your 4 times your salary. Now it's
Yeah.
like 20 times. So question, Chris,
Yeah.
IWM. See,
Yeah.
back in let me share my screen. Let's see, back August, beginning of August, saw a touch off of that 200 moving average. Is this ratio spread territory here?
So I'm slightly lower on ratio spreads. Yes, I have a let me see what I have running on IWM right now. I'll check my whole portfolio. I know I have some longer terms. I do have some shares. I bought IWM along with everything else. So when IWM was around the bottom, I saw 170 good technicals. I bought this thing at like 179. So I bought shares at 179, which is pretty good timing during the April dip. But I was foolish enough to start selling calls at 200. So I've just been selling calls for the last like 4 months, 200 calls, 200 calls, 200 calls, 201, 202. Like I'm trying to move my strikes up a little bit. But my cost basis is all the way down to like 165 on the IWM. So I own shares way cheaper, which means if I am currently just going to keep generating income, I think we're pretty well insulated where I don't have to buy puts anymore on IWM. I'm just going to keep selling calls because they're in the money. But for a new trade, Alex, I think that like a 200 to 195 zone would be like, if I'm going to take some more shares, it'd be like a dip at 200. So let me see if I can price that out right now. So we're looking at some rate cuts by the end of the year. Let me go IWM. And then I'll also share like current positions I have running. So I know I have shares, IWM shares. I've got the covered call. I've raised my strike price up to 202. I've got some waterfall income trades in IWM. I don't have any ratio spreads at this time. So let me see if I can find something that I like. Let's go.
Look at Paul over here. He's 199 mortgage rate, 1.99% mortgage rate.
For a 15-year, to be fair. I mean, you
yeah,
typically get a much better rate on a 15 than a 30-year, but
Yeah.
still, man, that'd be like probably a sub 3%, like a sub 3% 30-year, which is
Yeah.
amazing. Amazing.
that is sick.
Yep. Yeah, and that was like I mean, obviously like during COVID and the first like, you know, COVID to like 2021, it was get it while the getting's good because rates were super, super low. I mean, a lot of people were easily doing sub 4. I mean, I think I closed on a house in Michigan at like 2.72 during that window, which isn't bad. Like 2.72 for a 30-year wasn't bad. Some people, friends of mine, got like 2.5s and 2.4s. So again, I don't know if we're going to see those rates anytime soon. In fact, I think this idea of like, man, I wish interest rates would come down. If we're lucky, guys, I think we might see interest rates maybe drop by 50 to 100 basis points, maybe. But I think we'd be very lucky to do that, and we probably see like a stall in the market for rates to come down because it's two things have to happen. It's either going to be rates come down, which right now are showing like bond prices and yields are not showing that. They're not going to reflect like lower prices and yields. So therefore, borrowing rates are still going to maintain like elevated levels, or house prices have to come down. And if you mess with people's home equity, you mess with people's housing prices, that's not a good thing either. I mean, think about if somebody's, I'll go back to that example. I have a $300,000 house that's worth $1 million. If somebody was going to mess with my 700K equity that I think I have, it's going to make me change the way that I'm investing. It's going to make the way I change on my consumption.
Make the way you vote.
Yeah,
change,
yeah, that too.
So that's
That too.
another thing to consider.
So,
Yeah.
all right, let's go to this Russell ratio spread. I think that 200 is a pretty safe level, right? 200 is a pretty safe level, meaning if I'm going to give myself a buffer, let's go like December 19th. I'll go to that monthly expiration. If I go down to 200, that's actually outside the expected move. I can buy the 200. I can sell the 195. Guys, I think that's a pretty good income trade. I could do a 200 by 195, have about a 91% chance of profit on the Russell, be willing to take the shares. So if I did a ratio spread, I'm willing to own the shares. But if I took the shares, I would do a break even of 195 minus 5 minus a buck 89. I'd own shares of the Russell at 188.11. So what's that discount from current price? So if we come down to 188.11, that would put me, I mean, the Russell would have to drop around 17.5% by the end of the year.
Okay, I guess. There we go.
So, I mean, if
really
we're looking at this like thinking that we can get to all-time highs and we can have a catch-up trade, I think the Russell staying up and elevated and buying dips, it's like, I mean, I think we get to 245 in the Russell. I think we could potentially break 245. So to me, that'd be a pretty high probability income trade. And if I own the shares, I own it at 188, I can repair that thing, hopefully lower my cost basis down to like 175, 170, and just stick with the multi-year range that the Russell's been in. What could be interesting is over this next like 4-month window, so like August, September, October, November, December, so 5-month window, and then going into a new Fed regime in 2026. I want to say like it's probably as good a time as any as the Russell can get for like rates to look better, businesses to have some opportunities to refi, and hopefully we can have this like soft refi window. Because the biggest concern right now is this like debt bubble of $40 trillion globally that's going to have to be refinanced at potentially 2 to 3 times higher percentage rates. I just right now it's like this current administration is so pro growth that it's like Trump and company want to slash rates aggressively. Even Scott Bessent's talking about cutting like up to 1.5%. You know, so I mean, Jeff, thoughts on like the percentage of Russell companies that are not profitable? Because there's a lot of them. That's my only concern with the Russell. That's my only concern is you play the index, but like a lot of these companies aren't profitable.
No, they're not. And that's I don't like the Russell, to be honest, but I do watch it all the time. I mean,
Yeah.
and I trade it some, don't get me wrong. But I mean, if you look at I think basically what they did, they took the worst companies out of the Russell 5000, stuck them in the Russell 2000, and said, "There's the trash. Let everybody trade that." And I'm pretty sure that's what they did.
Yeah.
So, but another thing, I was just going back to your trade here. If you do the Jans, you pick up another $40.
Yeah, I thought about that too. Seasonality wise, like I like the December. So
Okay.
19th to let's go 19th to 31st. So we got Russell, we got 18th, we got Jan 15th. Okay, so let me go Jan 15th. So basically, I just kind of let it marinate over the holidays, which would be an extra. Sorry, go back to trade here. So okay, so I have the 19th, and then I go to the 31st, then I have the 16th in Russell. So I could go an extra 18 days and grab an extra $40, which isn't bad for probably a still high probability.
Hmm.
Yeah, let me see here. So I like the 200 as kind of my buy zone. I can actually bring in a lot more credit if I do like a 196 by 195. I can make 285 in that trade, but I give myself left of a profit window. Let me see if I can go. I'm happy making like over $200 on the trade, so I think I'm going to do this, guys. How low could I go for a $200 winner? Let's find out. For a $200 winner, I can go quite a bit out of the money here. I can do a 187 by 186 with a 92% chance probability. It's only about a 10 delta, so I've got about a 90% chance that everything stays out of the money. I grab over $200 of income. That's a pretty high probability. I'd also, if I own the shares, maybe I can get the 186. So my previous break even is 188. This would be a 186 minus a dollar bonus trap minus the $2 credit. So I'd own it at 183. So we're a lot closer to like that 170 support. So if I had to own shares, I own it at, I like that trade, guys. I'm going to take the trade. Let me see if I can get you filled here for like at least $2 credit. I'm going to try the Russell right now for $2. It's going to be a ratio spread 187 buy put for one contract and then a 186 sell put for two contracts. and that would give me a little profit trap of $1, and then I have the $2 income. So hopefully I can close this out for a $200 winner.
You in
Let me see if I can-
January?
It's January 16th. Yeah,
What's up, Jay? First time. Welcome, my man.
202. I'm going to take this trade. See if I can get filled. Hopefully $2 or better.
I got 203.
You getting filled?
Yeah, I got to fill the
You
203.
lucky dog. All right, a 202 is not filling. 201 is not filling. $2. Come on, Tasty. Don't.
You
All right, it's
said
got filled for $2.
you said the buying the put 186, selling the
I'll put it in the chat right here.
Yeah, okay.
IWM
I see 203 right now.
116 of 26. So I'm buying the 187 put with one contract, selling the 186 put with two contracts. I got filled for $2 credit. That's my trade.
Put. Yep.
Okay. Yep. So $2 credit. Just gonna fill this on my margin accounts. Okay, so that should be good for like $2,000 for me by the end of the year or in early January. I'm willing to
About
own the shares. I'm
90%.
willing to repair the trade if I have to. But I don't think I'm gonna. I mean, I've got about a 10% chance of assignment. So odds of that obviously pretty slim. But if I get assigned, I can still repair the stock.
Yeah.
All right, so I'm gonna keep it in for $2.
Yeah, Jay, welcome, man. Yeah, ratio spreads are a little more advanced, but they're not. Chris loves them. We talk about them.
It's like a fancy naked put. It's kind of because what it does is it helps kind of instead of a naked put just being long delta, you have a little bit of a buffer there because you actually put in a buy put, so it offsets that like pure delta exposure. Which all that means is if the market were Russell goes against me, it's like having a naked put at 186, but based on the option chain right now, it's only a 10 delta. So the probability of that trade staying out of the money is still very high. So I take on typically like way less risk doing a ratio spread than I would if I just did a naked put. So I sacrifice a little bit of profit as far as like the net credit, but I'm also always willing to kind of repair my ratio spreads. So
Well, you also have a hedge on though, because you got a put spread along with the naked put.
yeah, but it's only like a $1 wide put spread,
Well,
so it's
that's
not
true.
like a
I'll agree
huge
with
hedge.
that.
It's just
Yeah.
a little. Yes, it's like a little
Yeah.
bump. Yeah,
Yeah.
it's not really. If I was doing 5 wide, it'd be different. Like if I was like, oh, this is a $500 profit trap.
Yeah.
Well, that'd serve as more of a hedge to me versus like a $1. I'm
Right.
really using it now for income.
Yep.
Yeah.
Yeah, you do need the buying. You do need the buying power to do that. iPad.
Agree. Yep. A lot of times when I take a lot of those trades, if I take them, they're in my Project Options Edge, which is usually my more like advanced service where we have more buying power. We own shares. We add covered calls. We do campaign trades. So it's a little bit more like I'll say labor intensive, but truthfully, the idea is I've got about a 92% chance that trade works out, and I just get $200, and I'm profitable. So that's really the plan, is just to get me paid on that trade.
So we have had a few people. We were just talking about Delta. I think this is we did this last week. It's not bad to review this stuff, especially we have some new people here. So and I want to get to Jeff, your thing as well, because before, when you got on, we were talking about SPY and day trading, and I know you do that stuff, and that's really cool. I think people are interested in day trading. I know I do it every day too, and you have some good stuff with that. But so Delta, right? So Jay, for everybody else who's new, a few people new, let's go over Delta again, right? Because the Greeks, people get afraid of them. It's always worth it. Review things, more than once. I know when I was learning, I had to watch the same YouTube videos like over and over and over again to really understand them and play around with them, right? So for instance, again, what are options, right? Just to lay the groundwork, these are derivatives. Give the buyer the right, but not the obligation to buy, which is a call, or to sell, right, which is a put, an underlying asset at a strike price by expiration. So there's 4 components of a option. There's the premium, which is the price you pay for the option, or the price you receive for it, depending on if you buy or sell. There's the strike price, right? So if Apple's at 220, you want to buy an option at 220, that's your strike price. Expiration date, when that option expires, right? How long until that option contract expires? Underlying asset, of course, Apple, NVDA, IWM, whatever. Again, there's two types. There's call options and there's put options. Call options are bullish, means you think the stock is going up. Put options are bearish. You mean you think the stock is going down. Now, all that being said, Delta is one of the Greeks. And what are the Greeks? So they are risk measures that describe how option prices change with various factors. If you go to your terminal, you can watch in real time as these option prices change. And it's like, why are they changing? Well, it's because of the Greeks, right? So there's 5 main Greeks. The one that we were just talking about, Delta, right? We're going to talk about that today. That's a sensitivity to underlying price changes. You can see gamma, there's theta, vega, and rho. For beginning traders, or I think the first ones you're ever going to work with is delta and theta. Rho is pretty advanced. Most retail traders don't even worry about that. Vega's a little less advanced. You might, as you get more experience, want to worry about vega. Gamma is helpful, like a second tier of understanding, but delta and theta are first tier options Greeks that you need to understand. Delta is probably the most basic. So what does delta do, right? Delta measures the expected change in an option's price for every $1 change in the underlying asset's price. The formula is change in option price divided by change in underlying price. That's delta. Now, delta is an absolute measure, though. If you go to your terminal, you will see on the put side it's negative delta. On the call side, it's going to be positive. So that's because when a stock goes down, your put increases in value. It's really, when we talk about delta, we don't talk about negative delta, or you just say delta. So if the put has delta of 20, the call has delta of 20, it's the same thing. Now, delta changes depending on how far out of the money or in the money you are. At the money options means that if IWM is at 227 right now, and you buy a call option, right, at 227, you'll have delta of 50, right, 0.5. Now, as you go farther out of the money, that delta will decrease, right? As you go more in the money, that delta will increase. So for instance, IWM was 227 and you bought a 220 call, you would have much higher delta, right, than you would at the money or out of the money. So what's cool about delta is you're wondering about what is the probability of this trade working out. There's other factors that go into it, but it is kind of a standalone measure, at least a approximation measure of what the probability that option you are buying will, the probability that it will expire in the money. So if you are at 227 on IWM and you buy an option with a 30 delta call option with a 30 delta, basically a 30% chance that call option at the expiration, say September 19th, 30% chance that will be in the money, right? So again,
Kind of like a binary option if you think about it. I mean,
yeah,
if it's above strike at expiration, it's at 1. If it's below strike, it's at 0. And when you're getting in, it'll be at 50 or around there anyway. But yeah, it's like a binary option almost.
yeah. Yeah, and so again, positive delta means option price rises, the underlying price rises, so that's going to be calls, right? Now, you'll rarely ever see a delta of 1 or a delta of 0. Delta approaches 1, as you get deep in the money. You have to go real deep to see a delta of 1. At the money calls, at the money calls, it might be on a further slide, at the money puts as well, right? Which means at the money means that option contract, the strike price. If IWM is at 227, at the money means you're taking a strike price of 227. That's at the money. It's at the money that the underlying is trading at right now. So you can see this right here. Stock at $100, right? Call strike of $95, which means, right, it's in the money. That has let's say it has a delta of 70, right? 0.7. So if stock rises to $1 or $101, that means the option price, a delta of 70. Remember, delta, the change in the option price versus every $1 move in the underlying stock. If the stock rises to 101, that's a $1 move up. That option price will go up by 70 cents. Does that make sense to everyone here in the chat? Let me know. Now it's the opposite for put options, right? It's the exact, well, it's not the opposite, but you'll see negative, basically when for put options, when this underlying price falls, the option price increases, right? Because you're taking a put, right? You're betting that the stock will fall. And again, just like with calls, delta approaches -1, which is the same as on the call side. You rarely ever see a -1 delta unless you go really, really deep. But again, just like calls at the money, puts are going to be 50, right? Which means it has basically a 50-50 shot at owning, at being in the money at expiration. And then on deep, out of the money puts, delta is going to approach 0. Okay, so for instance, let's look at this again. Stock is at 100. This time though, the put strike is at 105, right? So this means you're in the money because you're betting the stock is, basically going to go lower, but it's already, the stock is already lower than the put option you're taking. 70 delta, just like before. This time though, if stock falls to $99, because delta measures percent change in the option for every $1 move in the stock. If stock falls to $99, the option price goes up by 70 cents, right? So how do you use delta in trading? Well, so delta will tell you how bullish or bearish your position is, right? So you can look at, this is more advanced, total delta of your portfolio for net exposure. And it's also, again, a probability proxy, right? So percent chance of expiring in the money. So a 30 delta call equals 30% probability it will expire in the money. You take a 10 delta, it's going to be 10% chance. And that's what Chris was saying. When you combine, this is just, we're talking about single leg options, so a call or a put. You start combining them, you start selling them, you have to calculate the net delta. And for like a ratio spread, you throw, or a credit spread or debit spread, like your net delta is going to be the difference in delta between those two positions. And so that's when he's saying it's about 90% chance of what, being out of the money or whatever. 90% chance of winning for him. It's like, that's how you calculate it. I know you're selling a credit, so it's kind of maybe the opposite, but for folks to understand the basics, that's how you do. You combine the delta of the different options legs that you're owning or opening when you create multi-legged contracts. That's like the net delta of the position that can calculate the net probability of profit. Hedge ratio, I don't want to talk about that. It's advanced. You're not going to really be doing that. There's no reason for most anyone that's, not trading, advanced strategies to really do that, or a lot of money to do that. But again, you can see kind of the lean of your portfolio, right? For contracts, right? So if you, each options contract, each option contract represents 100 shares of the underlying ticker. So if you own 100, if you buy one contract of Apple, that represents 100 shares of Apple, right? And so to get like the, delta, it's delta. So it's like 70.7 times 100 times the number of contracts gives you like your net delta exposure. Here's a cool little table for this. So this is just a little visualization. If you had a delta of 80, of 0.8, right? That means you're in the money and it's highly directional, right? You think the stock is going to go up. It's going to be, a bullish bias. A delta of 2 on the put side, right? That's low sensitivity to price action. So a delta of 2 means that for every dollar that the stock moves, this is only going to move 20 cents. Versus on this one with the 8 delta, with the 80 delta, every dollar that the stock moves, that call option is going to increase by 80 cents. So there's less sensitivity on out of the money options, right? Now they're cheaper because of that. So they're cheaper. So that's cool, right? You can get in, you don't have to spend, $400. You can spend $100, right? If you go farther out of the money. And if you want to just make a balanced play, well, you can take the at the money. Again, that's a 50 delta. It's about even whether it's going to win or not, basically. Now, again, what affects delta? In the money, at the money, or out of the money? In the money is going to have more delta. At the money is going to have medium delta. Balanced delta. Out of the money is going to have really low delta. There's also time to expiration. So longer dated options are going to have delta. They're going to have less extreme deltas, right? Because there's more time for the option to play out. So, if you take a shorter, like a weekly, right? You're gonna have more. You're gonna have deltas that are more in the like as you time expiration. You could longer dated options have deltas closer to 0 or plus or minus 1 extremes less sharply. That's because theta smooths out delta. We can talk about theta later, but theta can smooth out delta. There's more. Basically, shorter term options are going to be more volatile, right? Because there's less time for price to interact with the underlying price interact with the delta of the option. Implied volatility also is worthy of its own discussion, but it does affect delta as well. And then there's also the stuff like rho, kind of advanced, not really super important for basically any trader that's watching this. I would say that's probably right. I mean, I don't know. I've never worried about rho at all. Chris, Jeff, I don't know if you guys have.
Not really. It's more
never watched
theta, delta,
Yeah.
theta, gamma.
Yeah, delta. Those are
Vega.
really,
Yeah.
Those are those
Rho is like interest rates, right?
Yeah.
Nah.
It doesn't really matter. So really quick, wrap this up. Bullish trade, right? Let's look at an example with a real, I've been talking about this. Let's look at it on the screen. You buy Apple $150 call, right? You buy the Apple $150 call. Apple is at 155. This particular option is in the money, right? It has a delta of 660. Now, so if stock, right? What is this formula? I wrote it last week. So if stock goes up $5 because of this delta, the option will increase by $3, and that's the formula, right? Because you multiply the delta by the stock movement, right? For every dollar, right? It moves up by 6. So if it goes up $5, right? Multiply that by the delta of 60, the option is going to increase by $3. So if you bought this Apple $150 call, right? At 100, or sorry, at $1, right? And Apple goes to 155, or Apple goes to 160, goes up to $5 to 160, right? Now your call option is going to be worth $4. So you win, right?
Well, this is another thing about what he's talking about here. A lot of people like to trade options, and just like if you're looking for a stock to pull back or even to break out to the upside, whatever it is, let's just say stock, whatever the stock is trading at $98. You say, well, I want to buy it when it gets to, $100.50. Well, you can use the delta to calculate where that option is going to be once it gets to that point, so you know what price to buy it at. That way you're not surprised, like, hey, that thing went up in value. Well, yeah, it did, because now it's moved up a whole lot higher. But you can calculate about where that option is going to be once you reach a specific price in the underlying based off what the delta is doing.
Yeah, great point. Yeah, so you're doing the technical analysis on the chart, and you're like, well, when do I, like when would I exit? Like, what do I need the stock to do? If like you're looking at this in a $100 stock needs to hit $150 by the end of the week for you to make money on that option, that's probably not going to win, right?
Yeah, exactly.
So you need to pay attention to that. So that's delta. So for everybody, we're doing a bunch of new options trading stuff, tomorrow and the subsequent days. But just thought, because we had some new people here, because we were talking about delta, it'd be worthy just to spend a few minutes reviewing that. But yeah, that's it. That's how to do it, folks. So now delta applies for longer term options. It applies for shorter term options. It applies for 0 DTE options. It applies for weekly options, right? You always want to be paying attention to delta. And especially if you're using options to day trade, it can be a powerful tool. And I think Jeff has some more info on that.
Yeah, and I was going to say, if you do like trading options or even day trading options, I have my 1K Academy that we look at trading that every single morning at the opening bell. We actually look at trading the QQQ at that time. And last week we had 3 winning trades, boom, boom, boom. And looking again this week, this morning, we're still trading. I had the first 30-minute range of the market, so they haven't gone anywhere this today. And I
No.
think Chris is right. They're just waiting on Jackson Hole more than likely.
Yep.
But anyway, but if you're interested in that, we'll be showing a replay here in about 1 minute. So if you want to hang around for that, check it out.